is up, guys? Happy Sunday. Hope you've had a great weekend. So I'm sorry I didn't have a video last weekend. I was out of town. We went to Vegas, and just a few observations. Being out there firsthand is extremely expensive. The flight, the hotel, obviously are going to be very expensive. And even the food, the going out, the alcohol, whatever it is, it has all been inflated beyond what I feel is normal. And even from a busyness standpoint, I've been out there, I don't know, 7, 8 times over the last 10 years or so of my life. And it's not quite as busy as I remember it being. There's certain pockets of busyness, but I don't think it's recovered to the point that it was prior to COVID. So just an observation, that reopening trade, that reopening theory of everything should be booming right now, I'm not sure it's quite there. And I'm thinking the casinos, the clubs, the bars, all these different places out there are trying to jack up their rates to kind of compensate for what's happened over the last couple of years. So just an observation to keep in mind. So moving forward, I want to touch base on some headlines and data from last week. I will cover one thing from the prior week. I didn't have an earnings calendar from this prior week either, but I will go over some of the earnings that I watched. I still paid attention to some in addition to their risk ranges. So we'll focus on some things from last week, and then we'll move on to forward-looking information. I want to go back 2 Fridays ago when we had the consumer credit numbers come out Friday afternoon. And just a simple observation, total consumer credit is at record highs, $52.4 billion. And these credit numbers include revolving and non-revolving. So this is credit cards, student loans, car loans, things like that. So keep that in mind. But total revolving credit, as you can see below that, $31.37 billion, a record high historically. So what that's saying is we talked about the savings rates that have been depleted back down to 2013 levels a few weeks ago. And now what it looks like is people are putting a lot of money onto their credit cards. So this inflation is likely affecting a lot of people in a negative way. And now they're using their credit cards to pay for things, whether I'm sure it's energy, food, whatever. But I don't have the numbers on that. But this is not a good sign moving forward. You know, if as the Fed continues to raise rates, these credit card interest rates are going to start going up too. So everybody that's maxing out their credit cards is going to have a very difficult challenge ahead of them. Last Wednesday, we got the CPI data out, and there's only a few areas that actually contracted. So let me just go over the color scheme here. So the yellow items are the ones that have increased from the prior month, but at a lesser pace. The green are ones that increased at a faster pace than the prior month, and the red are items that actually contracted. So the ones that we've actually seen contract, oddly enough, energy commodities, gasoline, which went down month over month, used cars and trucks, and apparel. So maybe people have less funds to spend on those discretionary things that they would have in the past. Anything in the green is an increase at a faster pace than the prior month. So food away from home. So I'm guessing that's going to be going out to eat, energy services, utilities, all items, less food, energy, commodities, new vehicles, services, less energy services, and transportation services. So it's just kind of interesting to see the areas that are still increasing and the ones that have actually contracted a little bit. Now, I still don't see enough evidence here to say that what the Fed is doing is actually helping anything yet. So I would like to see a lot more of these start to contract and come down before I can say, yeah, inflation is starting to be tamed and getting under control. The day after we got the CPI reports, we got the PPI report, the Producer Price Index. And similar to the last chart, anything yellow is an increase over the prior month, but the rate with which it increased was less. And anything in red is going to be a contraction. So kind of just, I'm not an expert at the PPI stuff, but it just basically shows you that prices are still increasing from the producer side, which again, we've talked about. Those costs will be transferred into the consumer side. So I still would expect some price increases on the CPI side moving forward, but at least you're seeing the rate with which they're changing lessening, which is a good sign. But again, we're not seeing enough contraction here to say that what the Fed has done has crushed demand enough to the point that it's dropping prices and dropping commodities. Friday, we got University of Michigan consumer sentiment readings. Now, what I'm showing here is a plot of consumer sentiment in blue along with the NASDAQ Composite Index. So it's really interesting to see sentiment is down to levels we haven't seen since the financial crisis lows in 2008, 2009. But look where the NASDAQ still is. So it really makes you wonder, is this, some people may look at this as we're possibly at a bottoming because sentiment is so low, but that doesn't mean sentiment can't continue to go lower, below even 50. So this is not a positive sign of what's to come. If sentiment is this low and the NASDAQ is still up here around this 12,000 mark, there could be a lot more pain to come. Just similar to look what happened back here in the dot-com bubble, right? So sentiment got super low relative to where it was, but the NASDAQ hadn't bottomed at all yet. So there was still a number of years before it actually bottomed out and started to move back up. So again, not another good positive sign from a sentiment side given where the markets still are. Even since I didn't even do a video last weekend, I still want to go over some of the earnings plays that happened this past week with their risk ranges. These are just some of the ones that I was interested in. I didn't cover every single one of them. So let's just kind of briefly go through these. So again, your solid lines are your standard deviation risk ranges. So again, 68% of the time we're closing within that range, statistically speaking. And then the long dashed is your second deviation. The short dashed is your third deviation. So let's look at Upstart, for example, here. This one got completely annihilated. So it blew past its second deviation, opened up below, didn't quite get down to that third deviation, but it closed outside of that. So this is that rarity where it actually closes outside between that second and third deviation. I actually had a calendar spread on this, a put calendar spread, thinking it would go down to around 55. It blew right through it. Thankfully, being it's a calendar, I didn't, lose too much on it, but it's still, even when you're right, you can be wrong in certain instances. So again, I did not expect this to go down 50, 60, 70% in a number of days. And again, all these charts are 15-minute, 5-day charts, so they're just basically last week's activity. Peloton, pricing in a $3.95 move, plus or minus. You can see came down here on earnings, tapped that lower risk range, bounced a little bit, tapped it again, bounced back up, closed right in the middle. So any options holders here got screwed. If you were a seller of, for example, a straddle, you definitely made money. It's always a risky move in a stock like that, though. Coinbase was another one that was interesting. So these are your standard risk ranges up here, pricing in $18.75 move. Even earlier in the week when Bitcoin was getting hit, it was dropping below that first deviation right off the bat. So this was under a lot of pressure early on in the week, and even on earnings, it dropped below that second one, even retested down below that third one, and got a nice bounce here. So what's interesting down here, and even in an intra-week, you had a nice inverted head and shoulders potential here. So this might have some more upside, maybe even up to 80 this week. I kind of have an overall idea on what I'm expecting the market to do next week or this coming week, but we'll get into that. Yeti, another one that's stayed right within its range. Not a lot of activity there. Came down near that first deviation and bounced right back up. Disney was an interesting one. Stayed relatively flat most of the week until earnings. came down, tapped that first deviation, bounced, and came back up to close right within that range. Not unexpectedly. Beyond Meats was under some pressure earlier in the week. Again, got below that first deviation, and kind of how this applies to most of these, the banks tend to, or the market makers tend to have to dynamically hedge to account for these puts that are outside of their normal range. So that's why you see the pressure once it gets underneath this first deviation. You can see it kind of got down below that second deviation, but it bounced right back up within, and it closed within this range once again. So again, these statistics, guys, play out nicely in the majority of cases. There are scenarios where they don't, but it seems a lot rarer for that to happen. Sonos, again, another one that came down to that lower risk range of your first deviation, bounced right back up and closed within that range. So not a lot of craziness, with the exception of like Upstart here, Coinbase, and maybe a little bit of the Beyond Meat here. Now let's look at the indices from last week. So I'm only going to cover the S&P, NASDAQ, and the Russell. Each of these charts is your measured move for the week. Again, solid line is going to be your first deviation, so your standard risk ranges for the week. The longer dash is your second deviation. So below each of these is going to be your relative continuous contract, so your futures contract for its relative index as well. They all look very similar in nature, but what's interesting is they were all under a bit of pressure early on in the week, so they all came back down to this first risk range on the low side to begin. They even actually broke below it, so it got back below it, retested it as resistance, dropped even lower, almost down towards the second risk range here. Didn't quite get there, or the second deviation. And what's amazing is come Thursday, Friday, we bounced right back up and closed within this risk range. So again, the dynamics that play out here is they want to close these within the risk range. These markets are a lot more efficient than people give them credit for. In the case of the SPY here, it came right back down to this lower range, retested as support, and bounced on Friday. So very interesting activity here. You can see a little bit more of the overnight activity down here on like the ES contract. This is going to include all of your overnight activity as well. NASDAQ 100, very similar activity. Not a lot to report different than the S&P. The Russell was interesting in a different way. So you can see where the S&P held support here. The NASDAQ held it even better, but on Tuesday, Wednesday, the Russell actually broke below it. So this was a little bit weaker relative to the other indexes as it broke below its risk range. So as you broke below it here, you probably got a lot more dynamic hedging from the market makers that pushed this lower naturally. But again, coming towards the end of the week, Thursday, Friday, they stick save this. They gapped this up on Friday and held it above to close within that range. So again, very efficient markets from a statistical standpoint. All right, we've covered prior technicals and risk ranges from last week. Let's talk about some forward-looking charts. Now, before I get into this stuff, let me just say we have monthly options expiration this week. Friday is most of the May's expiring options. In addition to that, you have the VIX expiring on Wednesday. So in a lot of cases, not always, there are some underlying factors that, for example, because of the way the VIX was elevated for so long, I'm expecting some reprieve into that expiration. People start taking positions off. They close out options, which force dealers to de-hedge, take off positions that they were using to hedge their sold options to various people, hedge funds, whatever it may be. So I guess in general, what I'm trying to say is I expect some bouncing activity here. I expect some upside movement in the indexes. I can't say for certain that it's going to last a day or 5 days. I don't quite know. It just depends on the velocity of it. And we'll get into some more details on this stuff that I'm going to show you here. But So let's start with the dollar itself. We talked about the 103 area being important. The left chart is going to be the monthly chart. The right is the daily chart of the dollar itself, just so you have a larger time frame and a shorter time frame perspective on it. Again, this 103 mark was very important, which we broke above. As you can see over here, this is your 103 mark. And now that we broke above, I would anticipate at least a pullback to retest. I guess we kind of got one here. I don't always count the first one as an official retest. I like to see the movement get above that level and come back down and test it again to prove it as new support from prior resistance. And just something to note here on the RSI, you've got a lower high on the RSI, you've got a higher high on the price. So this tells me there's some potential bearish divergence there. Again, it's nothing to write home about. This thing could still take off and move to the upside. But generally speaking, if the dollar is moving up, it's putting pressure on the indexes. If the dollar is moving down, I would expect some reprieve. So maybe some buying potential on the indexes. So again, as we go into expiration this week, I'm expecting a little bit of pullback on the dollar with some upside movement on the indexes themselves. We've talked about the dollar. I'm not going to go through the euro and the yen because I think they all are relative to one another. But let's talk about TLT. Again, monthly chart on the left, daily chart on the right. We came down into this pretty big, important area here. Now, these lines are your risk ranges for the week, so don't mind that right now. So this is a pretty big level down here. What is this, around 113.50? So you can see we bounced off of that level nicely. This isn't exactly a huge bottoming candle, but you also have some pretty big volume down here. So the selling pressure is still on. The MACD is still pointing downwards, and the RSI is nearing that so-called oversold area, but that doesn't necessarily mean anything. But again, if the short trade is starting to wear its time out here in the near term, you've got some potential bullish divergence here. So you've got a higher low on the RSI while you've got a series of lower lows on the price. So that, again, is a potential bullish divergence. I'm not looking intraday here, so there could be some type of pattern here. Maybe there's an inverted head and shoulder that's playing out. And again, as we go into expiration, maybe some of these puts that were in the money get closed out and the dealers are forced to buy the underlying back, which forces it higher. So again, when you have to be aware of the time frame that you're in when it comes to options and expirations. The final part of the bond market I want to focus on is the 10-year Treasury. And this is a very big one from the tech side and from the risk side of things. So as rates go up on the 10-year, that tends to put a lot of pressure on the growth stocks and the technology stocks. And on the larger time frame, you can see we came into this big important level here, which is around 3170-ish, which was prior support, broke out, proved support again here, failed again here. And these are all, obviously this isn't a set in stone line, but this is from a historical standpoint an important level. And there was also an inverted head and shoulders here that kind of played out up to that level as well. So the price target has been achieved again as we're in an options expiration. Are we going to get some reprieve here? If we go over to the daily time frame, similar to the dollar, we've got a series of lower highs on the RSI, and you have a series of higher highs on the price side. So again, this is what I would call a bearish divergence. We broke out of this trend line here, as you can see, but we have yet to back test it. So I would like to see this come down. And again, if the 10-year were to come down and retest this level as rates drop, I would expect that to allow some buying to come back into the markets, right? So you're going to see tech and a lot of these beat up stocks start to rally again. And you've already started to see a little bit of that on Thursday and Friday, where some of the heavily shorted stocks were up 10, 20, 30% in a day or two. So keep that in mind going forward. Another interesting just observation here on the 10-year, you have a potential head and shoulders playing out here. Again, I'm not going to read into this too much, but I'm looking for at least a retrace down to this level, around maybe 25, 26, somewhere in there, give or take. So I'm hoping for some reprieve in the markets here with the drop in interest rates on the 10-year. Before we dive into the indexes and their risk ranges, I first just want to briefly touch base on options open interest because we are running into expiration week here. So the first thing I want to look at is the VIX itself. Now, the red bars on the bottom are going to be your put open interest. The green bars on the top are going to be your call open interest. So you can see 25 is the largest put open interest, and 30 is the largest call open interest. So when you talk about Max Payne theory, it's never a precise tool. It's more of just something to be aware of. And what I mean by that is a lot of times they tend to close options into expiration to make as many options worthless as possible. So simply that means I would expect the VIX to close somewhere in between this 30 and 25 mark going into Wednesday morning's VIX expiration. And again, the VIX options are based off of the VIX futures, not the index itself, because you cannot trade the volatility index. You have to trade the futures relative to the index. I know that can be confusing, but what I'm looking for, again, if I'm talking about the potential for some upside in the markets going into Wednesday, at least, I would expect some reprieve in the volatility index. So I expect the VIX to come down, and there's potential for it to come down all the way to maybe this 25 mark. Now, if we get to that 25 mark, I expect there to be a bit of a wall there. So they would call that a put wall, which means it's going to be hard to break below that level. That's not to say it can't. But the more they push this below that, the more these puts get to be at the money or in the money going into expiration. So I see that as less likely. So again, I'm looking for the VIX to kind of pull back, drop a little bit lower, giving the indexes a little bit of a boost up higher. Now let's look at the spiders expirations for options. So you can see a massive amount of puts, right? Look at all these puts relative to the call activity up top. So you've got a large skew to the downside, and understanding the dynamics of options, they can tend to pull an index lower the more open interest there is on the lower side. I'm not going to get too deep into that. I'm not an expert at it. But you can see the largest put open interest is around 380, and it's not as significant. You've got some 450 calls up here, but I'm not even interested in that, given we aren't even anywhere near that. But you have some interest around 400, even more at 410, and more at 420. So because we're this near to these levels going into expiration, these can hold some importance. And, this would burn the most put options going into expiration too, right? So if they can drive the price back up to 420 on the SPY, they're going to screw all these puts. So these will all be worthless going into expiration. And a lot of times they love to do that. So again, just something to be aware of. It's not a precise tool by any means. Being that we covered the SPY, I also want to cover the SPX, so the S&P index options themselves. These are the most liquid of all the index options, so that's why I like to be aware of where these are at also. And as you can see, 4,000 is going to be your largest put open interest as well as call open interest. So given this, these expire Friday morning, mind you, so these will not be active in Friday's session. So going into Thursday night, these will be expiring Friday morning as the market opens. So what this tells me is I would expect some movement around this 4,000 mark. Again, 4,000 is a important psychological level. We broke below it last week. I think it's kind of the last stand for the bulls to kind of take it back. It's no surprise that we bounce there and we potentially get some more upside. So again, that's kind of why I'm looking for a little bit of a reprieve in the markets going into this week. I don't know how long that's going to last again, but keep this in mind. Your ranges can go up to 4,100, 3,900. So I would expect maybe some ping pong action around this 4,000 level as we go into expiration for the S&P. Now looking at the QQQs, once again, it's not surprising that we have a good large open interest around this 300 level is around where we are as of Friday. I think we're a little bit above that, but this is because of the price being in this level. I kind of look for this as an important level this week. In addition to, we've got some large open interest around 320 and your largest call open interest even up to 330. So could the QQs run up to this 330 mark? I wouldn't rule it out. It's a long ways up there for a weekly move. And if we look at the risk ranges, we can kind of see where this lies in there. But again, if they can push this up there, they can screw a lot of these puts going into expiration. So the downside is limited as far as an expiration standpoint, an option standpoint, but that doesn't mean it's impossible. So again, just another thing to be aware of. And lastly, let's look at the IWM. I'm not covering the NDX options or the Russell index options because they're illiquid. Again, that's why I only look at the SPX index options themselves, but the IWM gives us a better reading on the Russell 2000 options. So similar to the S&P SPYs, you've got a lot of put open interest down here skewed relative to the call side, right? So that leaves more opportunity for upside. The dynamic potentially here is as those puts get closed out, the dealers are de-hedging, so they're taking off short positions that they put on to hedge their sold puts. I know that's confusing. If any of you want me to go over my understanding of that, I'm happy to. But again, this 180 mark is a very important level on the IWM. Your largest call is all the way up at 200. I don't foresee that happening unless a miracle happens, but you look kind of towards the nearer term open interest, so 185. You've got some big put interest there down to 175. So not a lot to read off of this, but again, this 180 will be a very important mark going into expiration. So I would interpret this as any closing between 200 and 180 is potential to screw the most options. You know, below 200 screws the most calls. Above this, you know, around 190 could screw a lot of these puts too. So again, that's where they talk about the Max Payne theory of options. So SPY is pricing in a $16.83 move. That takes us up to around this 429. Coincidentally, nice previous resistance areas. And the lower side takes us down to around 395-ish. So nicely and coincidentally lines up with these previous resistances here and the support that we talked about. This is this larger time frame trend line I was talking about. So you've got a nice confluence of support down here. And you can see there's a gap here. We've got another gap here. So there's kind of some unfinished business in this area. That's why I'm really liking the prospect of a long position down in here somewhere, guys. Again, because of the way the market is working in volatility, there's always the potential that it comes down to this level nicely and bounces. Or I've seen them flush below this, you know, who knows to what extent, and then recover this at the end of the day. So you get this long bottoming type of capitulation candle. So you might get a big body and a big wick on it. So we've seen that before too. You kind of got one here. So just keep that in mind. Now we springboard into the current SPY chart as of Friday's close. Look at this beautiful drop down below this trend line here, guys. 395 was kind of the level I was watching, but we mentioned the possibility of going a little bit lower, which we came down to around 385 here before they recovered it. You know, they dropped below this trend line, they trigger some sell stops, buyers step in, and get it right back up to 401. So if you were a long swing trader, you took a decent risk reward long position down here, and so far you're in the money. As far as movement going forward, SPY is pricing in a $13.53 move, which takes you up to around 415 and down to around 388. Now remember, we mentioned that 410, 420 mark that was kind of important from options. So if they can drive this up, you know, I could see the potential for them to get up to even 420. There is a big gap up here around 430 that never got closed out. Could that happen? Yeah, I would expect the dollar and the 10-year to both be pulling back quite a bit more. So we just kind of have to play it out. Again, once you get up above these risk ranges or below them, you've seen how they drive it right back within that range within a day or two. So another thing to kind of keep a note on here, and this doesn't show perfectly on the S&P itself, but we have seen it on the QQQs. So you've got the potential for a head and shoulders as well. Now this didn't play out perfectly. You know, price-wise, we didn't come down to that 415 level here, but the psychology still stands. So you have to be aware of that. And that's why I'm trying to be aware of this level up here as your neckline. And if you were to measure this move, you know, 480 up here was your high, down to 415. So you take that distance and you measure that below the neckline, which probably takes us down to around this, I'm guessing 350-ish mark. I don't have this precisely laid out, but which again, or not again, but it lines up nice with this confluence of prior resistance, right? So you get the first bounce off of this big trend line, that broadening wedge we've talked about in the larger time frames. I'm not going to show it to you again. But then you get this bounce up to the neckline to retrace, to prove as resistance, and then finally you get that big drop back down. So kind of like we talked about, I expect a little bit of a reprieve in the VIX, but I think that will kind of reset the bears to take back over and give us a nice potential shorting opportunity for these lower levels down here. Let's move on to the QQQ. Very similar type of action. Again, we broke below this trend line down here. This was a longer weekly trend line that got broken right in this confluence of prior resistance, right? And then you got that bounce. So similar to the SPYs, but we've got a little bit different angled head and shoulders playing out here that we've brought up previously. So you've got that left shoulder, head, and right shoulder, and this 320 mark, kind of like we mentioned with the options, is going to be very important. Now, just like the SPYs, there's a gap up here around 330 that they could come up and try to fill. You know, maybe they drive this up here, and one random day they gap us up here. And if we do something like that, I would expect some big selling pressure to drop us right back below, because that is not going to last. You have a large number of longs, I think, stuck up in this range, you know, all the way across here. So there's going to be some heavy selling pressure if they get to that point. I'm not saying they will, but if this head and shoulders does play out, this would be your neckline that I would expect price to reject. So again, I'm not going to go through and, well, I might as well here. Let's do that for the fun of it, right? Just so you guys can see what's going on in my own head. So if we change this here, and if, again, this is our neckline, let's make this a little bit bolder so you can see what I'm talking about. We'll make that a little bit thicker there. Now if we take a line up to this point, so 408 down to the neckline, and we transpose that from the break of the neckline, that takes us down to around 220. And if we look at a weekly time frame, oh, look at that. Coincidentally, it almost lines up nicely with this prior COVID area of interest, right? So you've got the COVID plunge here that retested this other trend line, and this would kind of backtest the COVID highs and the breakout here. So I'm not going to predict these things. I think the likelihood of that happening is much higher than us moving up. You can note even on the weekly here, look at the selling volume. So it's very relative to even what happened back in 2020, and I don't think this selling pressure has even begun. So again, we get up to this neckline, I'm going to expect some heavy rejection of price and a bigger move lower. I expect volatility to increase as well. There's just not a lot of positive things that are going to drive this market higher unless we have a miracle somehow. Now, the last ETF index, let's cover the IWM. And this one has been the weakest of all the indices, and rightfully so, as it's mostly small caps in the US. Moving on to the IWM. So we've got a bounce here. You know, I don't have the old weekly risk ranges, but like we talked about, it broke below the first deviation, the standard range, and recovered it at the end of the week, mind you, if you go back and look at the earlier in this video. And so moving forward, it's pricing in a $7.33 move, which takes you up to around, I believe it's around 185. I could see anywhere even up to this 190. And why I say that is you've got these confluence of prior support here that got broken. And again, this is all going to be relative to the dollar and the 10-year, right? So depending on what happens with those, that could give us a better indication of what's going to happen with the indices themselves. But as we mentioned, you get above these ranges or below these ranges, they tend to bounce right back in. So there is always that possibility of getting upside that a little bit more than you would think, especially with options expiration happening and such a large open interest on the put side. That can drive things up and squeeze things higher in the near term. But I think that's going to be short-lived. So we've got a lot of gaps down here, a lot of mess that still hasn't been filled. You know, the bulls stepped in before that gap was even filled, which to me, I count this as dead space. There's a lot of air pockets that need to be covered. I know we're super oversold here, but again, you can see down here the selling volume has increased, but even as we have started to rally, look at what's happening to the buying volume. It's just decreasing. So to me, again, these are bear market rallies. They don't last long. I would be very careful trying to catch any bottoms anytime soon. There's going to be a lot of time to buy the dip, and you need to be very patient depending on your time frame. We've covered the indices. Let's go over their relative volatility indices. So I'm going to cover the VIX as a whole because it's so important to the S&P 500 itself. Now, we talked about the options that expire on Wednesday, right? I remember how 25 was an important level, which brings you down to around here. You've got a gap that's unfilled right here. So that, again, could be a nice magnet going into Wednesday morning or Wednesday-ish, give or take, which would get us down back to this level. And I would expect the S&P to be going up inversely to the VIX coming down. Now, what can potentially be playing out here? You can see we keep bumping up around this 37, 38-ish level, and it keeps rejecting, right? The more we bump up against that, and the more we keep creating these higher lows, the more potential there is for this to finally break that level. And if we do, I would imagine the S&P will be dropping a lot faster than it has been within the last few months. And I would expect volatility to potentially spike up, you know, even around to this 50 mark. There's a gap up here around that 50-ish level. So a couple potential ways this could play out. This could be a bull flag. So we come up, bounce, resistance again, and then bounce back up before continuing. Or one could look at this as a cup and handle playing out here. So this is your cup, your handle's forming over here, which you would take this measured move, and this would put you back up to into those 50s area, which we kind of just mentioned. And one interesting part to this is, as we've seen the markets going down, volatility has been increasing. And I note this because you've got this expanding VIX, right? So as the S&P has been selling off more and more, this range is getting wider and wider. So to me, that's saying the selling pressure is increasing, the unknowns, the fear, the risk is rising, and that creates this expanding range of volatility. So things are not settling down is what I'm getting at. Things could get a lot worse than what they have been. I hate to be so bearish, but that's just what I'm seeing. So right now, let's look at the positives. The MACD is starting to curl over. The RSI is rolling back down. So again, this could give us a nice reset on the VIX itself. You know, maybe that's 3 days, maybe that's 5 days. We can't say for certain, but keep an eye on the VIX here. If they can get this below 25, even better, because then there's potential to drop back down to 20. But I have a hard time thinking they're going to get below this 25 level. So we'll have to keep an eye on that this week. Now let's look at the VXN and RVX. So the VXN is the volatility index for the NASDAQ. And what's kind of interesting here is, note the VIX made a series of lower highs, while the VXN is making a series of higher highs. So the selling pressure is increasing in the NASDAQ itself, and these are kind of telling you two different stories in addition to the RVX. So the Russell 2000 is making a series of higher highs as well. So it kind of makes sense because the S&P holds a lot more risk-averse type of equities that are doing well in a rising inflation environment. But eventually that is going to crack too. That is a short-lived momentum for those sectors and indices, or not indices, but those industries, I should say. And eventually that's going to crack as the Fed continues to raise rates and tighten from a financial standpoint. So I'm just saying these are things to be aware of. And you still have you can see the MACD hasn't quite crossed over on the VXN and RVX. So there's a little bit more selling pressure to the downside on those two indices. So if we don't have a strong small cap index and we don't have a strong tech sector, we have a very difficult market that's going to be under a lot of pressure moving forward. Another thing I'd like to go over is the top 10 S&P holdings. Again, these are our 27% weightings of the S&P index itself. These 10 stocks hold that much weight and value to it. These are your Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, Berkshire, and JP Morgan. So these are very important mega caps to the index and the overall markets themselves. Now, I wanted to show you this index that I've created. I've gone through it a few times. You can see this prior trend line here that I formed connecting these previous highs. We came down and retested that just as of last week. You've got a decent bottoming candle. I'm not reading into it too much. You've still got quite a bit of selling pressure down here. Yeah, the MACD is pretty beat up and the RSI is reaching that oversold. But again, that never is a single set of indicators to trade off of. What I did do is I'm trying to see if I can create a risk range for these. Now, I've never done this before, so this is more of an experiment. So what I did was I took the risk ranges for each of these stocks and I multiplied it by its relative percent weighting, and then I sum those up. So if you do that for these 10 stocks, you get a $12.85 move. So I'm really curious to see kind of how this plays out in the coming week. If these actually get a little bit of a bounce back up to this level, which is around, and I know you guys can't watch this, so it's probably not important to even go over it, but 254 down to around this 229. And if we break back below this trend line, again, similar to the other indices, I would expect the selling pressure to increase moving to the downside. Now, if for example, these can clear this level and break above it and hold it, I want to give you more of a potential bullish component to this. Maybe this forms a head and shoulders, or an inverted head and shoulders, right? So maybe there's a potential for left shoulder, right shoulder, and this thing to springboard up. And if that does happen with these stocks, that's going to give a lot more support to the bullish case for this overall market. You can see the MACD is so beat up, so is the RSI. The RSI is starting to turn back up. You want to see this MACD cross back over and curl up. So if anything, pay attention to these 10 stocks to make sure what they're doing is going to be important to the overall markets. We've covered enough of the indexes, so let's just kind of recap some of the earnings that are coming up. We've got Walmart, Home Depot, Target, Lowe's, Bath & Body Works, Kohl's, Ross Stores, Decker, Foot Locker, John Deere. These are all good earnings to give us a better indication of how the consumer staples side of things are doing. So things that people need versus discretionary funds. Is Walmart holding up well? Is Target? Is Home Depot and Lowe's from the home improvement side of things? Are people still spending money on things that they're fixing up at home? How are Walmart and Target faring in this inflationary environment? Are they getting pressed with margins with the food side of things or any of that nature? So these will be good ones just to kind of keep an eye on. I'm not too excited about a lot of them. I think most of the moves this week will be probably headlines driven, and then options expiration will be a big part of that. So let's move on. Let's see kind of what we have on the economic calendar coming up. So Monday, we've got Empire State Manufacturing. Tuesday, we have retail sales excluding vehicles, business inventories, building permits Wednesday, housing starts, Philly Fed manufacturing, jobless claims Thursday, and Friday advanced services report. So not a lot of major stuff happening this week, which might be a good thing for the markets itself. And maybe that gives us a little bit of a reprieve like I was looking for. But overall, guys, I'm really sorry to be super bearish right now, but I have to be attuned to what the technicals are telling me, and that's just where I'm at right now. Once things change, once we get some of these geopolitical factors, once we get some of this inflation and Fed issues out of the way, then I think things will get a lot better. But for the near term, brace for some pain. Be very cautious in what you're doing. Again, I can't tell you what to do, but in a high volatility environment, you just have to be careful not to hold on to things too long. And if you're not a short trader, just stay out. Cash is a viable position, especially if the dollar continues to strengthen. That's a good place to be. So I appreciate you guys watching. Thanks for your time. Always open to feedback, suggestions, ideas. Please like this, comment on it, share it with your friends, and I appreciate you guys. Good luck and have a great week. We'll talk soon.